Okay, while people are filtering in, we're going to get started again. Our next two presentations are first by René Stulz and then by Till Sherman and his collaborators. René is Everett Reese Chair of Banking and Monetary Economics at The Ohio State University. And I first met René at the NBER Summer Institute, where he chairs the Risk in Financial Institutions session along with Mark Carey, which basically melds together, as we try to do here, the practitioner's approach along with the theoretical and academic and other approaches to risk management. So I've learned more from René than probably almost anybody else about risk management, and I think he has a lot of wisdom to share with us today. René, the floor is yours. Thank you.
Thanks. And usually at this point, you thank the organizers for inviting you and giving you the opportunity to speak. But in this case, actually, the organizers gave me homework. And so I'm not too sure about how I should thank them. I'm going to talk about crisis on risk management in the context of Polycrisis. And at this point, academics are pretty lazy, and so they make heavy use of ChatGPT. I asked ChatGPT what is Polycrisis, and you can see that the answer is a bit weird. Now that it's an online platform where people can solve real-world problems together. I think the answer for the problem, for the reason why it failed, is given by this Google Trends clocks, now which shows that the interest in Polycrisis became quite big this year, but which is after the versions of ChatGPT that are freely available were trained. Adam Tooze is the one who kind of popularized this concept. And he has all sorts of friends, including artist friends. And so one of his friends created this artist rendition of Polycrisis. I thought it was about as useful as the answer from ChatGPT. So after seeing this, I decided that it makes sense for us to go back to basics. And now kind of use the same, if you think of the simplest definition of Polycrisis, you think of multiple crises all at once and feeding on each other. And so what I did with the paper that is going to be available is now go back to what is it that we know about crisis? What do we know about their frequencies, their predictability? What do we know about contagion and compound risk in the context of crisis? And then I will talk about how does Polycrisis help us understand crisis. And at the end, focus on kind of how should we think about this in the context of risk management. So to talk about crisis, you have to define what a crisis is. Now, to kind of justify focusing on crisis, there really has to be something that's qualitatively different. Now, if it's just a little bit, something that's a little bit worse than the normal times is just a small quantitative difference, then there's no reason analytically to treat them separately. If they are qualitatively different, then they call for different policy responses and they call for different risk management approaches. So the definition I will use it at the country level, and it's a situation where the economy or the financial system no longer work normally. Okay, you can use that type of definition now for other entities, but my talk will only be at the country level. So let's talk about frequency. Now, since the GFC, the economists and financial economists have spent a lot of time creating databases on crisis. And those databases are all global, because if you want to do statistical inference on crisis, you can't do it at the country level because the crises are too rare. Okay, and so people have focused on kind of two types of databases. Databases that focus on economic crisis, which are sharp GDP drops, and financial crisis, which are cases where the financial system that doesn't work. Now where you have kind of a big government intervention, bank failures, and so on. So I will talk about the data for both types. For some reason, people who have looked at economic crisis have focused a lot on 10% GDP drops. And the most recent database kind of comes to the most recent years and has an extremely large number of countries after 1950. And that's the percentage of countries that are in that crisis situation now of where you have the start of a 10% drop in GDP to the trough of the drop. Okay, and you can see that this frequency is pretty stable over time with some exceptions. Now, and if you look at the exceptions, you see that they have a lot to do with the world wars, World War I and World War II, and with the crisis of starting in 1929 in the early 30s, the Great Depression. I have two separate lines here from that database, which is the gray line are the countries that were in the database in 49, and so are more developed countries. The blue line includes emerging countries, includes a lot of emerging countries. And you can see that the more developed countries have a lower frequency after World War II of those economic crises. But if you look at the frequency, it's 2.3% per year. So a country now is expected to have one on average, almost one into 50 years. But no OECD country has had one since World War II. Our related database now looks at 40 countries since 1870. What's interesting in that database is that they get 183 of those crises, economic crises, and there's a lot of clustering. Now, so lots of things going wrong all at once, but here all at once means in lots of countries at the same time. And you have 31 countries have, out of the 40, have such a crisis during World War I, 35 during World War II, and 23 during the Great Depression. Now let's turn to the financial crisis. There are a number of databases that have been developed, and they differ in the number of countries and they differ in the time period. The first one looks at 17 advanced countries. And in those countries, you have a financial crisis recession that starts 4% of the years for the whole period. But I mean, one thing that's striking with financial crisis is that actually we have this period from 46 to 72, where the database has no financial crisis, and databases in general have no financial crisis. Now, so we had this extraordinary period. From 73 to 2008, the frequency is 3% in that database. No, so still in all of the cases, no, the frequencies that we have seen tend to be less than 5% and quite a bit less than 5%. So that those are the crises in the database. And we talked about clustering, now which is, I mean, clustering being lots of crises at the same time. Here is a country crisis, but as kind of a feel of polycrisis. And you can see that is this data set now, which has 17 countries. 2008 was quite exceptional in the number of countries being in crisis at the same time. Okay, and so when you look at those 17 countries from 1870, 2008 is truly exceptional, and then now kind of the early 1930s as the next set of the next big cluster. Okay, so if with that database, nothing is going on until between 2008 and 2018. There is a more global database, which is this Leuven and Valencia database. It essentially looks at all countries that are part of the IMF. And you go from 1970 to 2020, you have 151 banking crises. But since 2011, from 2011 to 2020, the database has only 4 banking crises in quite small countries, except for Ukraine. Okay, so when we think of the data that we have seen, important features that there is clustering, and so there is something to the notion that crises happen all at once. But there is also this difference between developed and less developed countries. And none of the plots that I showed, or none of the databases really implies that the frequency of crises has increased. Now, there was this long period after World War I with no financial crisis, but then we have gone back to something that is a bit similar to what was before World War II. The most recent database, it's a paper from this year, looks at 46 countries from 1870 to 2016. And they look at crisis, banking crisis, where either you have a panic. Now, panic would be SVB, Iran. But here, you have kind of a run on the systems rather than individual banks. And they look at a bank equity crisis, which is a 30% drop in the market capitalization of banks, and widespread bank failures. Now, for panics, they have a frequency of 2.68% for the whole sample period. It's higher since 1980, 3.91%. And for bank equity crisis, it's 2.09% for the whole sample. But again, that's higher since 1980 at 4.36%. So it looks like this over time. And with that database, you have a couple of crises, which are equity crises after 2008. And you also have 2 countries that have run crises. But again, now 2008 is again quite unique when looking at it from 1870 to 2018 to 17 is quite unique. So that's for the financial and economic crisis. Now, with polycrisis, people focus also on different types of crises, non-economic crises. So the databases that I look at have currency crises and sovereign crises. Those tend to happen quite a bit. Now, in the database of the IMF database, you have those crises essentially happening every year. They're also clustered. Now, the peak year for currency crisis is 1993, but there are also 10 in 2015. Now, remember, in 2015, there was this dramatic drop in oil prices in 2014 and 15 that created havoc in emerging markets. Now, the Stulz talks a lot about climate crisis. I think the problem with climate crisis is that it's kind of on a different time period than the crisis that we have been looking at here, that economic and financial economists look at. No, they tend to look at 1 year on something that happens within 1 year, or with financial crisis, they look at panics, which happen over a very short period of time. And so that's kind of a different definition of crisis when you look at climate. Now it's with that. Now with tools, I think we are going to be in a climate crisis until we die. But so when you look at the data for kind of nature disasters, you can do that in some countries. You can do that for the world. Now in the US, 125 county level disaster declarations from 1920 to 2010 with 20 or more deaths. Okay, and so you could say, well, those are crises, but they are very localized. They're at the county level. No, there's nothing that kind of raises to the level of the country. Lastly, political crises. Now there are well-established databases that look at political crisis, global databases. There is a project in political science that has gone on for more than 20 years, kind of collecting the data. And the database is from 2018 to today. And perhaps not surprisingly, the highest number of political crises is in 1939. If you map the number of countries in crisis, in a political crisis over time, and by political crisis meaning two countries here having a tough, kind of having a dispute, it looks like this. No? So that again, it's a plot where you wouldn't say that the 2000s look worse, but no, it doesn't go to 2022 or 23. But again, there have been those crises over the whole period of time, and 1939 is kind of the worst. So that's kind of a summary of the data that we have on kind of the lessons from when we look at frequency. The next topic is, well, as a predictable. No, by predictable, I don't mean, oh, gee, you can say that in 10 days a crisis will start. No, that would be absurd. And now with market efficiency, if you know for sure that it's going to start, it's going to start today. And so that's not what I mean. What I mean is, well, can we put a probability number? Does that probability estimate change depending on circumstances? Now, are there periods where the probability is much higher than other periods of time? And so I'm going to focus on this notion that now the probability differs across countries and differs over time. And since the global financial crisis, actually a lot of work has been done on that. And the outcome is quite interesting. And I will talk about that. It's more interesting over time than across countries. Across countries, if the numbers are quite interesting if you look at those databases. But now you would think the US is this wonderfully stable country, and Argentina is a basket case. But in those databases, Argentina and the US have the same number of crises. Okay, the country that really stands out is Canada, and it has only 3. And what it tells you is that the nature of the banking system matters a lot. But so now the question is, how do you think about some countries having 9, some countries having 3? Is it just random outcomes? And the answer is no. There is quite a bit of research at this point. There's research highlighting the nature of the banking system, but there is also research highlighting the institutions. Countries with poorer institutions and less respect for law and order have more crises. No, and so there is variation across countries. Predictability across time. Now, what we have, so this database goes to 2021 for 20 advanced countries. They look at tail outcomes for GDP. They don't measure the tail based on the whole period. No, they look backwards to estimate the tail. They have 102 crises. 35 banking ones, 43 resulting from war. There are 9 from natural disasters, that's COVID. And also 9 countries end up in a crisis based on this way of looking at crisis. But one thing that's important in that database is that the frequency has fallen between the first half of the sample and the second half, and the severity has fallen as well. Now, so the typical crisis in the second half of the sample is 6% drop in GDP, and the frequency is less than 2%. What they do next in that paper, which is relevant for us in terms of predictability, is they construct what they call a disaster index. That's kind of a measure of the probability of a crisis in the next 2 to 4 years. And they have a findings that other people have as well, which is when you want to look at predictability over time, you have to look at the interactions between risk factors. Each risk factor individually doesn't tell you that much. When they interact, then that makes a big difference. And so by looking at the interaction between past credit growth and past stock returns, they managed to predict half of the crisis that took place over the sample period. If with a false positive rate that is not that high. If you look at each one of those 2 risk factors individually, you don't do very well. Okay. Now, another feature that is important in those studies is, now you would think, well, if you are going to have if the probability of a crisis increases, the stock market should be doing poorly. Okay, that's not what people find. Okay, which is the probability of a crisis is elevated when valuations are very high. Now, which is a challenge for some versions, at least, of market efficiency. And it also kind of creates problems if you are going to use stock returns to think about predictability of crisis. The other paper that has drawn a lot of attention is by uses 42 countries from 1950 to 2016. They look at financial crisis. They have a probability of 7% of this happening. But they show that when you have both rapid credit growth and asset price growth, the probability of entering into a crisis over the next 3 years is actually as high as 40%. Now, and so the additional papers that look at this, so it's a finding that at this point, one has to take very seriously. Now, there's a lot of variation in the probability of a crisis through time, there are times when the probability of not it happening next year, but over 2 or 3 years is quite elevated. But if you look at credit growth alone, without the movement in the stock prices, it doesn't explain very much. So that paper constructs a red zone indicator. And for them, the red zone is if you're in the top quintile of business growth over the last 3 years, on the top tercile of stock market returns over the same period. And when you're in the red zone, the probability of crisis is 45%. They look at this both for household credit growth and for business credit growth. It turns out that historically, you either have business credit growth or you have household. It's pretty rare that you have both being elevated. Now, and so before 2008 in the US was in the red zone for that paper for 4 years. All the results of those papers hold if you take out 2008. But so we had household credit growth being elevated, but not business. Both types of credit growth with stock market return or valuation increases lead to prediction of a crisis. There's a vast literature on contagion, and some of what Rob talked about is kind of in the spirit of that literature. Obviously, I don't have time to go much into it, but what I want to say is that papers that find predictability in crisis, in financial crisis, or in economic crisis, now also find that if there are more countries that are in crisis, then you are more likely to be in crisis. No, so there is this clustering effect on it's big, and it can make, it made a big difference for the US. Now, the US entered the red zone in that paper that I just mentioned in 2002. It had a 31% probability of subsequent crisis. But because other countries saw an increase in the probability of crisis, the probability of crisis of the US increased because the increase in the probability for other countries. On that effect alone, got the US to go from 31% to 51%. So what about the non-economic shocks on crisis or non-economic crisis on economic crisis? So the evidence is pretty clear that political crises are bad in the sense that they lead to economic crisis and they make economic crisis worse. Okay, and so now that of the GDP crisis from 1870 to 2021, now the 35 that are banking crisis also. So you have kind of a banking risk and an economic risk. GDP falls by 8.8% in the year of crisis. There's 43 GDP crises that involve war. GDP per capita drops by twice that, no, more than twice that, 19.5%. People have looked at natural shocks, kind of floods and so on. People have looked at that for the US. Again, the problem with those shocks is that they're always localized. Okay, and so this paper by Blickley, Hammerling, and Morgan looks at the impact of those shocks on US banks, and they have to work hard to find them. Now, one thing that happens is natural events have both negative and positive effects on banks because the demand for loans increases. People have to rebuild. So let's now turn to the polycrisis. Now, people in this room, or at least people in the front row in this room, like kind of operational quantitative definitions. We don't have that for polycrisis, which I think is kind of is a problem. Now you can implement definitions using the tools that Rob talked about, or tools that I have developed in some of my papers. But now for our purpose, you can think of it as heightened risks, so that multiple crises become much more likely, or multiple crises occurring all at once, and that those risks or crises are kind of feeding on each other. Now, one thing that now tools, I think, says a lot of good things. Useful things. And now one of the things it stresses is the uncertainty that surrounds many of the heightened risks. Now we would think of this, in kind of using the concept of radical uncertainties that the speaker at lunch now developed. But it gives the example of nuclear war as a result of the Ukraine war. Now nobody would dare to put a probability on that number. It wouldn't make any sense. He also argues, on that polycrisis is required because we are in a unique period. Looking at the historical data that I showed, there are periods with lots of crises before. So our time is not unique. And now I have learned over life that you shouldn't disagree with Larry Summers ever. But this is a case where he supports tools by saying, I cannot remember moments when there were as many separate aspects and as many cross currents as there are now. I think I think I have to disagree with that. And there are plenty of times in the histories that we looked at with lots of events taking place and lots of crises. But there is also a bit of a kind of a paradox and I hope that Dick will forgive me for using this. And now on the one hand, now people are talking about this being this extreme period with all sorts of problems. But you look at the VIX and it's below 18, now, which is extremely low. So, and you look at the OFR index of financial stress, and it's actually, when I did this 2 days ago, and it's below zero, meaning that we are in good times. Okay, and so you can think of this as well. Maybe it's really hard to kind of capture some of the things going on in indices, or it may be that now it's easy to get uptight about events, and I think it's important to put them in perspective. So compound risk and polycrisis. Now we saw that there's plenty of clustering. So clustering is well established. We talked about compound risk making things worse. Political risk clearly makes things worse. And we saw that now the probability of a crisis is higher in a country when it is also elevated outside of the country. And so in that sense, there's plenty of evidence that it's correct that if you have kind of multiple crises or elevated risk in multiple dimensions, that worsens the resulting economic crisis if it takes place. But now going back to this notion of climate crisis, no, I don't know how I would quantify it at this point. But it does point to kind of an important dimension of this is looking at history assumes that the future might be a bit like the past, but there are dimensions where it's not going to be that way. No, and so climate is obviously one dimension where the past may not be very instructive about the future. So these issues of non-stationarity are really important and one has to be careful with. Now, if you have followed Stulz, I mean, he spent his youth in Germany, so he likes to use German words. And so he talked about Krisenbilder, and that's what it is. No, and so if you want a CRO to become dizzy, and now maybe Thiel should go around and with show things like that. I'm not sure that it's very useful. But there is a lesson to this. Now, in risk management, we use heat map. Now, where we try to classify risk according to magnitude, severity, and frequency. To the extent that there are compound risks, this doesn't capture them. No, and so what you really have to think about is, I mean, can we adjust heat maps? Can we think of heat maps in the context of polycrisis or in the context of compound risks? And the answer is yes. No, in the sense that what you need to do is really have a heat map that is conditional on some risks being elevated. And if the concept of polycrisis is correct and relevant, then the conditional heat map will look very different from the unconditional heat map. But now one last dimension in this is, now we can look at the crisis we know, but obviously there are risks of crisis that we don't know. And it's important in terms of risk management to be prepared for those as well. Now that goes back to the radical uncertainty. So let's look at a couple of lessons for risk management. Now, one that is important. I mean, some people here are old enough to have looked at risk management models before 2008. And now there were some banks and some non-bank financial institutions that were telling us that they had risk models calibrated so that they had enough capital for shocks going to the 99.95 percentile. And now, when you think about that, kind of the historical evidence on crisis is a good way to kind of calibrate what you're doing. Now, if you think that you're ready for 1 in 1,000-year events, then it means that you are ready to do very well with the crises that we have talked about, which are going to occur at the rate of 5 per 100 years or 6 per 100 years. So it means that when you think whether what you're doing is reasonable, you have to take that historical evidence into account. You have to take into account that some crises are predictable and some are not. Now, going back to the stationarity, I mean, one can criticize Taleb for all sorts of reasons, and sometimes it's really hard to take. But his Turkey metaphor is kind of a wonderful illustration of non-stationarity. Now, the turkey on 2 days before Thanksgiving is very happy. It has eaten a lot and everything is going well. But 2 days later, it's on a table somewhere. And so based on the past, the turkey would never have had the ability to figure out that 2 days later, it was going to be on a table. The last, I mean, to me, kind of probably the most important lesson for risk management is that people, I mean, firms, whether financial or non-financial, really have to invest in resilience and being able to kind of roll with the punches. And now there's evidence of the benefit when you look at financial institutions. Jamie Dimon loves to talk about a fortress balance sheet that's building resilience. I have looked at the COVID crisis, and there you find clear evidence that the firms that were more flexible financially or were more flexible operationally performed a lot better during the March collapse. Now, and what we find is if you split firms between the least financially flexible to the most financially flexible, the difference in the drop in the stock price is 10 percentage points. There is also nice evidence on operational flexibility. When you don't, I mean, unknown risks, the only kind of way to cope with that in terms of managing risk is resilience. But for the type of crisis we talked about, now it's very difficult to protect yourself except through being more resilient. So conclusion, now we saw that the historical frequency goes from 2 to 7%, depending on the definition. We saw that some crises actually are quite predictable, but some are not. We saw that compound risks make crisis worse. We saw that political risk is really the major non-economic risk that makes crisis worse. We talked about non-stationarity, and obviously it would be nice to talk more about it, but non-stationary risks and unknowns really make mitigation difficult. Then we concluded by talking about resilience and how it works for mitigation, even for risks that you know little about. Thank you.
Thanks, René. Before we take questions, I want to say 2 things. First, René, you may not have been glad that we invited you to write this paper, but I am absolutely delighted. I've learned so much just from listening to you. And the second thing is, I thank you also for putting up the Office of Financial Research Financial Stress Index, because I always looked at that in the context of the volatility paradox. That is, when this thing is low, it gives people the incentive and the wherewithal to take on more risk, which lays the groundwork for future crises. So if you agree with that, I think that would be, that would be helpful. In any case, we've got time for questions, and I'm sure there are some. You had one before. If I could take any others. Okay,
thank you. There's a lot of work going on by McKinsey and everything about risk analysis, the VUCA cycle and everything. But I'm trying to get more insight on how you do systems analysis. And what's number one, the role of people coming from different perspectives, and how do you do that? Like engineers, mathematicians, lawyers coming together and doing some analysis, and how do you communicate that? And number two, there's a work by David Snowden, started working with the European Union and risk analysis, complexity science. I don't know whether you know about it, but if you have an insight on that, it's a broader way of building resiliency, mostly in the OECD and the EU.
So the next speaker, Till. No, as I don't want to put the burden on him, but his paper actually kind of uses the language of systems and system analysis, and is going to be much better at answering that than I could be. I mean, now compared to a whole bunch of people here that have a huge amount of technical expertise that I don't, I tend to now believe that kind of focusing on things in the simplest way you can has a big payoff, because you can actually communicate it to the people who make decisions. Now I have a broader view of risk management than kind of the typical definition. Now the typical definition is a misnomer, because you say risk management and it has nothing to do with making decisions about taking risks. Now that's part of risk management as well. And so whatever is done in risk management has to be such that the people who decide on taking risk actually understand the implications of what they are doing. And so I'm not a great fan of kind of the complicated system analysis stuff, because now it leads to pictures like this. I don't know what you do with that.
We probably need a lot of people understanding it. That's why I'm asking people from different perspectives to understand the parts of the boundaries of the system.
So having different perspectives is really important. Now having people with different sets of skills and different, now given the importance of politics to crisis that we've seen historically, now having people who can understand those types of issues and talk about them is obviously important.
Other questions?
Yeah, I was wondering if you could share your thoughts about the role of policy in all these crises. And really, when a crisis strikes, there is always this trade-off between balance management. You have to intervene in order to avoid that it spirals out of control, versus sowing the seeds for the next crisis, the more uncertain part. And so how can policy be shaped in such a way that we reduce the probability, especially if this polycrisis work?
I can't wait to hear Don gives the answers this afternoon. No, so it's a very important question. If I had had more time, I would have talked about one additional database, but now that you ask me about it, I will. So Yale has a project on financial stability, and they constructed a database. Now the databases I talked about start in the mid-19th century. The Yale database starts in the 13th century. And what they do is they collect data on policy interventions in response to crisis. And now we talked about the fact that when you look at this data, there's no evidence of things, no kind of crisis becoming more frequent. But the one thing that has changed quite a bit is the magnitude of the interventions. So we kind of have bigger and bigger interventions. They clearly reduce the magnitude of the crisis and the length of the crisis. Now it's, Paulson kept talking that you need a big bazooka, but now what he was using in 2008 was pretty small compared to kind of what happened in 2020. Obviously, it creates all sorts of issues. No, and I mean, it can make the market participants quite sleepy with respect to downside risks, because you think that intervention is going to be so fast and so enormous that there's not really going to be a big problem. So I mean, I do think that one has to think seriously about this. The answers that I had for firms, which is making firms more resilient, I think is also the answer for the financial system. Now that you want to kind of exert effort so that if shocks happen somewhere, that the system can keep going without a massive intervention. Obviously, we failed.
In the back.
There were a couple of slides where you spoke overlappingly regarding GDP crises as well as war and banking crises. If you've had any conversations with, for example, any IFI, Bank of International Settlement, or IMF or World Bank, how are they looking at things from a macro-prudential perspective as it pertains to how they advise and working with various different nation states? This might slightly fall in line with the policy question that previously asked.
Yeah, I mean, so now Tobias kind of talked about some of the things that they are doing on kind of for financial stability in terms of taking political tensions into account. And so now clearly, I mean, I think progress is being made when you think of political tensions on kind of what is known about risk management publicly, as opposed to what people do behind closed door. What was known publicly, political tensions didn't play much of a role. I think when you look forward, people are going to try to quantify that much better. But we know that the stock market reacts quite a bit to those events, and they can have implications for credit as well. I mean, again, resilience to me is the answer. But now there are cases where resilience, I mean, you can't really do anything. I mean, now to me, kind of one of the biggest threats to the world economy is if something were to happen to TSMC. Now, anybody who knows about TSMC would think that something happens to it, we have a major depression. But now what can a firm do, or what can a government do? Now we have the CHIPS Act, but we don't have the engineers.
Maybe time for a couple more, Rob.
I'm interested in the clustering, because we see this from the financial sector too, that the weaker the rest of the world is, the more it impacts us. So, and it's not surprising. So if you're a policymaker, do you take that into account? In other words, your policies have some kind of a cost benefit effect on your economy, but they also have spillover benefits. And I mean, I don't know whether this is what Simone was getting at with this question, but it seems to me, one of these things economists worry about.
Right. So I guess I'm looking at Don again, because now he has, but now if you think of October 2008, the coordination between the developed countries was hugely important. And so now the ability to coordinate and to come up with coordinated solutions is important in both preventing the risks from getting out of control and addressing them if they materialize. And the problem with political crises is that they get in the way of that coordination. And so that's one mechanism whereby they make things worse.
Comment on both things. I think your question was a really good one, because in a crisis, you're faced with the immediacy of, if I don't take this action, really bad things could happen. People will be thrown out of work, who are innocent bystanders, et cetera, et cetera. And it's very, and you tell yourself that you will take steps to prevent this from happening again. And that's what we did in 2008. And to your point, Rob, there was a huge amount of an intensification of international coordination and cooperation on the financial field. One of the things that the G20 did in the middle of the crisis was create the Financial Stability Board, or take an existing entity and give it much more authority to coordinate across countries. But it's hard because, and I think about the monetary policy piece, our instructions in the Fed were to create price stability and maximum employment for the United States. And we were responsible to, they are responsible to as Congress. And we often get questions from other countries, why don't you take our pain into account when you're driving your thing? But it'd be very hard to go to Congress and say, we subjected the US citizenry to less than optimal conditions because we were worried about Brazil or Mexico. Well, you can't really do that. So I do think it does make it these things like Financial Stability Board, IMF, et cetera. So there are ways of trying to make the whole world more resilient. And as you come out of the crisis, you say, yeah, I wish I didn't have to do this, but there are things we can do through like Dodd-Frank stress testing to avoid a repeat of this. Now, of course, the next crisis always comes from somewhere you hadn't anticipated.